One of the most universal mistakes made by a large majority of traders is not using a good ratio. Let's explore more in this video. There is an old saying among traders: it doesn't matter how often you lose, but how much. It's critical to cut your losses short. Equally, it's very important to allow profitable trades to run their course and possibly make more money. The best way to do this is establish a firm ratio of risk to reward. How much that is depends on your strategy and how long you usually hold trades. The most traditional ratio for people who trade over several days or more would be at least 1 to 2, often 1 to 3 or even higher. For scalpers and focused day traders, it's usually a lot harder to use a ratio that high. However, 1 to 1.5 is ideal where possible. The core idea is that the potential loss from a trade must never be higher than the potential profit under any circumstances, even if you are a scalper. Securing a good ratio is easiest with stops and targets. Once you've found the appropriate place for a stop, whether using ATR, PSAR, support or resistance or any other technique, set the target according to your ratio. Arguably, the biggest advantage of a good ratio is that it means your win rate is secondary. If you had a ratio of 1 to 2, you could lose money in a majority of your trades but still make an overall profit. On the other hand, if you have a negative ratio, you need to have a positive or strongly positive win rate just to break even. That's much more difficult to achieve consistently because you can never be totally certain of the outcome of any of your trades. Statistically speaking, having a negative or insufficiently positive ratio is the most common practical error made by traders. However, this can be corrected without much difficulty if you start using realistic stops and targets consistently. What's the highest ratio you've ever used? Let us know down in comments.